So welcome to the presentation on budgeting. Just to let you know, I've made some adjustments. This is going to be part one of two presentations because of the length of this presentation. So we're going to follow up with part two of two. Just a quick overview of the entirety of the presentation. It talks about the role of budgeting, the features of a budgetary system, the components of the operating budget, and then we're going to go right into the budgets all the way to the balance sheet using an example. Now, how does budgeting fit in with the strategic process and the operational control of things? Well, you start off with a strategic plan that develops into the long-term objectives of a company. Those are broken down into the shorter-term objectives, and then we have a plan. This short-term plan feeds directly into the budgets that we're talking about. And on the basis, once a budget is made, we have a feedback mechanism to see whether it meets the requirement of the strategic plan. So that's the whole planning and design process in a nutshell. Now, once we have the budget that exists, we will move into monitoring the actual performance. Once, of course, we're entering the active period for the budget, there will be a comparison of the actual versus the budget, and then investigation into why the differences exist. And based on that, you'll have a corrective action so that you can meet your targets. Now, sometimes the investigation will determine there's a bit of an issue, there's a problem in attaining the budget and attaining those goals, and that will provide feedback that goes again back into the plan. Now, the features of a budgetary system, there are several of them, but basically, the feedback should be based on actual performance. There should be some flexibility involved. Budgeting involves not just monetary but non-monetary incentives. It should be participative. In other words, not just coming from top down, but also including the people whose job it will be in order to execute on that budget. The standards should be realistic. It needs to be controllable. It doesn't help to come up with a plan that you can't control afterwards or can't measure. And then should be multiple measures of performance. Now, each department will have a budget that is related to the overall budget for the company, the master budget. The basis for the department's budget should be the volume of activity expected for the coming period. Now, the volume of activity depends on the department itself. Is it sales? Is it number of customer requests processed? Is it number of customer complaints, depending on the department? Is it the number of units processed, units produced? There are various bases for the level of activity that is important for a given department. As you see, based on that, then you have a flow of the budget. It starts off with sales, moves into production. If you're a producing or a manufacturing company, that then plays into the direct materials purchases and direct labor budgets and the manufacturing overhead budgets. Then we can look at the ending finished goods inventory budgets. Now, of course, these four spaces here are for a non-manufacturing, a retailing business or a service-oriented business that doesn't have to deal with those budgets. Then you have cost of goods sold budget, selling and administrative expenses budgets, and then finally the cash budget, which flows into the financial budgets of the income statement and the balance sheet. So the structure of the budget, of course, will depend on the kind of company involved, and whatever your department would be, your department will also be included because, of course, it plays into some aspects of the company's earnings, expenses, and use of cash in all cases. Now, here we have a sales budget. It's one of the easiest, not necessarily to forecast. In fact, that's very difficult to forecast. However, in order to calculate, it's quite straightforward. All you have is the sales in units, and then you have the price in units, and that you multiply the two, and you have the amount of sales. Now, forecasting sales does make use of assumptions about the future, and using a lot of external assumptions. In other words, what's going on outside, what's the competitive scenario. So there's a lot of judgment going on in there, and it's in a sense the most difficult to get right. I think given the coronavirus, I think no one could have budgeted for that, and I'm sure the sales budgets for most organizations has been quite radically different from what was originally planned. Now, how does budgeting fit in with the strategic process and the operational control of things? Well, you start off with a strategic plan that develops into the long-term objectives of a company. Those are broken down into the shorter-term objectives, and then we have a plan. This short-term plan feeds directly into the budgets that we're talking about, and on the basis, once a budget is made, we have a feedback mechanism to see whether it meets the requirement of the strategic plan. So that's the whole planning and design process in a nutshell. Now, once we have the budget that exists, we will move into monitoring the actual performance. Once, of course, we're entering the active period for the budget, there will be a comparison of the actual versus the budget, and then investigation into why the differences exist. And based on that, you'll have a corrective action so that you can meet your targets. Now, sometimes the investigation will determine there's a bit of an issue, there's a problem in attaining the budget and attaining those goals, and that will provide feedback that goes again back into the plan. So now we can begin the production budget. It's also based on the sales budget, but not on the sales number, but rather on the units that we assume to be able to sell from that budget. So we have the number of units here on the top, 50, 75, 90, and 80. And we have to make assumptions on the amount of ending inventory that we want. Here we're saying 20% is what we want to have as an ending inventory for the next quarter sales. And we're also making an assumption of the number of units that we will be selling in Q1 of the following year. Similarly, we also have ending inventory for the previous year, which was 10,000 units, or we're assuming that, because most likely we're producing this budget sometime towards the end of the previous year. So we already have the beginning inventory now. We're going to put it in there. And then with the desired ending inventory, we can see that we're looking for 20% of the next quarter sales. So the next quarter sales are 75,000. So we want 20% of that. So we want 15,000 ending inventory. Now we can calculate what our total needs are. And then based on that, we subtract the beginning inventory. So we need to produce 55,000 units. Now we can follow that along each of the quarters with one note. We have 15,000 units ending inventory is going to be the 15,000 units beginning inventory for the next quarter. Similarly, 18,000 here and 16,000 here. Now, we needed to know the information here regarding the expected projection of the future sales in Q1 of the following year, because we're planning to have 20% of the next quarter sales, in other words, the 12,000 as the ending inventory there. Now, for the entire quarter, for the year, the total sales in units is simply the total. But 2 points. The ending inventory and beginning inventory are not the sum across these, because the ending inventory is the ending inventory for the last quarter, which is 12,000. And the beginning inventory is the beginning inventory of the first quarter, which is 10,000. And as you can see, it will add up also going vertically here to 95 plus 12 gives us a requirement of 307,000 units minus a beginning inventory, which is 297. The 297 production will also be the sum across the 4 quarters. Due to limitations on YouTube, this is the end of part 1 of 2 presentations on budgeting.